Thanks for pressing play. This is the Pirate Street Journal. Three topics from business, tech, enterprise software, and the consumer, all through a category design lens. 10 minutes per topic, 30 minutes total. I'm Bree Clark. With me is Eddie Yoon and Christopher Lockhead. Hey ho, let's go. Hi, Pirates. Today's first topic on Pirate Street Journal is the American consumer sentiment just hit the lowest number in the history of the survey, and we're going to argue that that's good news. Our second topic is the synthetic customer, and that AI pretends to be your buyer, and why almost every company is about to use it to make themselves more average. And our third and final topic will be the younger generation, the most anxiety-ridden cohort in modern memory, why they're swinging for the fences when they don't need to be, and what that does to the way they spend, save, and gamble. We are recording on Friday, May 29th. Hey ho, let's go. Topic number one, the University of Michigan Consumer Sentiment Index just dropped to 44.8 in May, down from 49.8 in April. April was already the lowest final reading ever recorded, so we beat the record and then beat it again a month later. The mood was grim across both political parties, driven by high living costs and fear of more inflation. Lower income people and people without college degrees were the unhappiest, and we're told these are tough economic times. Tough economic times with effectively zero unemployment, strong GDP growth, the stock market at record highs, and entrepreneurship at an all-time high. So, something's just not adding up. And the consumer isn't behaving like the survey says. People aren't broke and curling up in a ball. They're getting smart. They're waiting longer to buy a car, buying less packaged foods, trading stuff for experiences. So the pessimism is real, but the adaptation is also real. This rock bottom sentiment is the setup for the best thing that could happen. The old linear life script of getting married, getting the house, getting the promotion, all those Scooby snacks that used to hand you purpose along the way is dissolving. When that script breaks, people have to go find meaning, belonging, and accomplishment on their own terms. And that's often painful. It's also the single biggest category creation engine in the economy. So, Eddie, record low sentiment might be the best thing that's happened to the consumer economy. If the old script for a meaningful life is dead, where does the next generation go looking for meaning, and who's going to get rich selling it to them?
Great. Yeah. So, I mean, it's a bit of an odd thing to assert that the lowest consumer sentiment on record is a good thing. But part of what is going on is a dramatic reshaping of the way that we live our lives. And in fact, how the American dream plays out, it's not, we would argue the American dream is even greater than it's ever been before. But the path to get there is going to be different. Because if you think about the consumer sentiment, how they spend, what most economists miss, and most of the Wall Street Journal and everything, hence the Pirate Street Journal, they look at the income statement of the consumer. How much money did they make and how much money did they spend? They rarely look at the balance sheet of the consumer. What does that mean? It means that the consumer balance sheet, in the historic way of looking at the American dream, was bloated in the sense that the path was linear. You went to school, you went to college, you got married, you found a job, and then you went on this kind of dog track with the bone hanging around just a little bit in front. The next promotion coming around, the next house, you need to trade up, two cars, two and a half children and a dog and this and that. And what we're finding is that it's all predicated on what we would call the big retirement life. That you need to do this for 40 years, chase the dangling bone that's running around the dog track, and then at the end, there will be a pot of gold waiting for you where you do nothing for 20, 30 years. And it turns out, A, it's not feasible for the vast majority of people. And B, doing nothing is no bueno for your health, your sense of loneliness, and everything else. We have Pirate Markham and his wife on their channel talking about, the retirement lie with that. And so what we're actually finding is that this generation of consumers is saying, no mas, they're taking Doge to the balance sheet. I don't need the fancy education with six figures of debt. I don't necessarily need the house that has more space than I actually need. And maybe I don't need to buy the car that has, that I upgrade every now and then on a regular cycle, because the Wall Street Journal has also said that there are 1 million fewer car buyers in the market. Why? You don't need to. Interest rates are high and they're going to stay high for the foreseeable future. And gas is high and gas is going to stay high for the foreseeable future. And so what we're actually looking at are, I think, a reckoning and a rejecting of the premise of the way that life is supposed to be lived. And for this next generation of consumers to say, you know what? Maybe I can live on a smaller balance sheet, which has much better implications for a skinnier income statement. And that what we often find is that the consumer may be different, but they're rarely illogical. They're actually doing the right thing for them given this day and time.
So, Eddie, why is the economy so strong on so many dimensions? We've got, very low unemployment, roughly 4%. We've got reasonable inflation at roughly 4-ish percent. We've got relatively strong GDP growth. The stock market's on fire, setting records almost weekly right now. And yet, I turned on my local news the other day and they're having a food bank drive, which is nice. And the news gal says, during these tough times, we really need a lot of at the food bank. And, I talked to a realtor buddy of mine yesterday and he says, at least here, the real estate market is frozen. And he told me something I had a hard time believing, which is in the state of California, two married young people, each earning $200,000 a year, have a hard time buying a house. So what are all these mixed messages, and why are you happy about them?
Yeah, I mean, I think the tough times is probably better labeled as different times. And, the old adage of your happiness, which is this is what consumer sentiment is actually measuring, is your expectations minus reality, right? And so a good chunk of the record low is that expectations were A, and now people are realizing that they have to be B. A being this linear lifestyle with a bloated balance sheet, B being a different life stages with a skinnier balance sheet. And that, if you think about where the future is going, if you believe in autonomous vehicles, where Tesla and Uber, they're Waymo, they're all betting big on it, is that why do we need to spend tens of thousands of dollars, take on huge amounts of auto debt for a fixed asset that we use maybe 5% of the time? Doesn't make any sense. Why do we buy a home that has
Hold
multiple
on, I have to
bedrooms that
interrupt
we
you.
don't
That
use many
sounds
times?
like a man who's never turned on the engine of a Shelby GT Cobra Mustang.
Well, more than one thing can be true. Both statements are actually true. And what we are finding is that what was interesting is some years ago, I wrote an article in HBR, cooking is going the way of sewing. And it pissed a lot of people off, right? And it turns out I was wrong in the midterm because of COVID. So everybody came back to cooking and baking. But in the long run, what are you seeing? DoorDash, Uber Eats, eating out, all going through the roof. How do you have to learn how to cook? You, generally speaking, you get married. You have to learn how to cook for two people. You have children. You have to learn how to cook for four people because it's expensive to go out to eat when you have a household of four. Now, if you have a household of one for an extended period of time, you probably won't learn how to cook. And so, in the same way that cooking is going the way of sewing, I'm sorry to say, my brother, driving may be going the way of horseback riding. Of there are some people who do it as a hobby and they love it, but you probably don't need to learn how to do it in the next 30
There there
years.
there is an organization, I forget what they're called now in the United States. Maybe Bree, take a quick look if you can. Founded by a bunch of guys who are committed to making sure that we continue to have the right to drive because they anticipate a future where the government wants to take it away from us.
Well, to your point, this is one reason you should get involved in local, politics, is that there could be a world where instead of the fast lane and the passing lane that you love to, get annoyed with people who are slow there, it might be the autonomous vehicle lane and the driving for pleasure lane. That might actually end up being something that we
As
see
long
down the
as they
road.
get out of the lane. So there's a we're gonna have a slight
They
diversion break.
they call themselves the Freedom to Drive. That, I think, is the organization you're thinking of.
Yes, the freedom to drive. We have a very famous mountain highway where I live. It's like a big, big hill, but they around here they call it going over the hill, and it's a twisty, turny highway. And there is a Facebook group for people to bitch about said highway because it's twisty and turny, and when it rains, of course, in California, we call that a storm. And so nobody can drive anymore. And so people slide into each other. And the nickname of this highway used to be Blood Alley. But anyway, so there's a Facebook group about this highway. And currently, right now, they're on the hunt for a blue Lexus. There is some guy who is cutting everybody off in a blue Lexus. And there seems to be an expanding group of people on Facebook who say they're going to go get him. And this one person says that they've got an uninsured beater and they're going to knock this person, I think it's a guy in the blue Lexus, off the road. All these people are now hunting this blue Lexus. And it's like watching a reality show on Facebook.
Well,
Okay,
I
so
mean,
what does that mean? Is the consumer going to continue to save the economy? What say you, Eddie Yoon?
yeah, I think what is going to happen is the consumer has held up the economy for the last X number of years, and we've been waiting for B2B to pick up the slack. B2B is picking up the slack with AI. They're betting huge on it. So thank goodness for enterprise really betting big on that. And the consumer, I think, is going to need to take a little bit of a break. And I don't think they're going to stop spending, but they are going to start spending differently. And what that means is that, remember, the thesis is the consumer is going from a bloated balance sheet to a skinnier balance sheet. And that what it implies is a massive redesign of analog categories. CPG categories are some of the biggest companies that Kraft, Heinz, Campbell's, Hershey. Their stocks are down 20 to 40% this year, the last 12 months. Why is that the case? Is that everything in the packaged foods category is designed for the nuclear family. Large pack sizes to feed lots and lots of people, that's not relevant anymore. And in fact, many of those things are designed not only for large families, but large pantries with long shelf lives. None of those things are in vogue anymore because they've turned out they're not necessarily good for you. And so you have a real reckoning coming where packaged foods is going to go under a real redesign of going from the nuclear to this nonlinear family. You're going to see this in the auto industry. The Cybercab that's coming out from Tesla is a two-seater on the bet that 90% of rides that are driven have one or two people. And guess what? The vast majority of our cars are much bigger than that. So there's a lot of reckoning to happen.
Cars. So could you call this one of the biggest Frodos in consumer history in the United States of America?
Yes. It's one of the biggest. I don't know how quickly it'll happen. That's the
Right.
caveat. It tends to go slower, but it is happening.
Long-term tailwinds moving at a slower pace. Are we going to have a good Christmas season, holiday season, spending wise?
If the stock market keeps up, then yeah, there'll be a lot of Christmas presents there and stuff.
It's every young person's dream if they're listening.
Quick break, pirates. Everything Pirate Eddie just said about the consumer, he's been saying things like that for 20 years across Harvard Business Review and now Category Pirates. Everything Pirate Christopher just said about category design, he literally wrote the book on it. 3-time public company CMO, co-author of Play Bigger. Now imagine both brains on demand for your business, your career, your next decision. That's the Pirate Eddie bot and the Pirate Christopher bot, trained on every Category Pirates mini book ever written, every super consumer framework, every creator capitalist take, and every category design playbook. You ask, they answer, in their voice with their lens. They come with the founding tier on Substack, alongside the full mini book library, the audiobook library, digital copies of all 7 of our big books, and every Scooby snack we drop. You can find it at categorypirates.news/subscribe. Now let's get back into the next topic.
All right, gentlemen, moving on to topic 2, the synthetic customer. There's a Bain article making the rounds right now called Synthetic Customers Earn Their Stripes. The pitch is that AI-generated buyers are already shaping real product and marketing decisions, and Bain back-tested digital twins against a real conjoint study, and the synthetic customers replicated about 90% of the key outcomes. The features that drive choice, the products to launch, even early price sensitivity, and companies like Target and US Bank are already testing products and messaging on synthetic audiences before anything goes live. But the way most companies will use it is the problem. So here's what we think is going to happen. Synthetic customers take off, everybody builds one, and they all point it at the fat part of the bell curve, the average customer, not the super consumer. They'll optimize the average into the ground and call it an insight. The status quo simulated at scale. So, Christopher, is the synthetic customer the biggest unlock the experience market has ever had, or is it the fastest way for an entire industry to optimize itself into beige?
It's actually both. So the synthetic customer idea and the technology, primarily driven by AI, but others behind it, is amazing. So imagine you're wanting to launch a new product, wanting to launch a new service, wanting to launch a new experience, and you want to know how to launch it best. You want to know what the reaction to your new offering is going to be ahead of time. You want to know what your best customers are going to think of it and how they're going to react, and ultimately how they're going to spend. You want to know these things before you launch, because the problem we have today, of course, is you launch something like that. Well, on the day you launch it, your costs are locked. You've spent the money, you've done the work, you've built the product. When we spent 3 years writing Creator Capitalist, we had a pretty good idea it was going to be a hit. Why? We have a Substack with thousands and thousands of people on it. They give us feedback all the time. So we had an intuitive sense that we were onto the right things. However, not all companies have that, and we didn't know we were 100% right because we couldn't do scenario planning. See, the exciting thing about this is you can war game out what's going to happen in your market. You can war game out what happens if a competitor does this. How's that going to impact revenue? How's that going to impact lifetime value, et cetera, et cetera. So this is a very exciting development, but most people are going to do it in a very predictable way, and they will scale mediocre as opposed to find the legendary. Now, Eddie, I have a pretty good idea why this might be the case, but I want to ask you what you think.
Well, I think you nailed it. Is that there's a lot of excitement about it, and the sad part is that they're going to take this new technology and try to make the legacy category slightly better. Versus, what if we just started from scratch and redesigned the whole Megillah, right? So the problem they're solving is exactly right. Is that new product launches take too long. They're way too slow. People are way too cautious. And guess what? The vast majority of them fail, right? Our buddy Pirate Don in our last Category Design Academy, he noted and he's built a career on 75% of new products fail. Now, that's inclusive on the B2B side. On the B2C side, it's closer to 99% of them fail. I mean, and failure
The
is
failure rate is insane.
it's insane. It's absolutely insane. So the problem is massive. And it's one of those things that people just have to kind of like acknowledge the problem is there now. However, if you try to improve the legacy solution, that's no bueno as well, because there's a couple of problems with it. Number one is that
Is the
legacy
first
market
one
research.
more stupid is more stupid?
That's right. That you to improve Dumb and Dumber, you can't get to a Dumb and Dumberer or whatever the sequel was called, right?
Yeah, I
I
think
mean,
that's what it was called, dumber.
well, and the problem is that I'm sorry to say, in the hierarchy of perception of business functions, market research tends to be towards the bottom. They are not respected in the organization. They tend to be people who are kind of focused on the data and not the reality of versus the reports that are there. And so you kind of have to take the synthetic consumer out of traditional market research. And so what does that mean is that in the same way that agentic AI, I mean, Christopher, you tell me if this is true, my impression is that it's not in the CTO's domain. It is embedded within every function. Marketing is doing, AI themselves. Sales is doing AI
That's
themselves.
right.
Finance is doing it. And so the same thing is true, is that the synthetic customer, if applied appropriately, would not be residing in the domain of market research. It would live in the function. And in
More than
particular,
likely, because it's the person in the function that has the question, right? So
absolutely.
if I'm on the product development team, product marketing and management team trying to figure out what we should build next, and I want to understand, I could go to our market research department, or I could ask Claude.
100%. And in the same way that we ask Claude, ChatGPT, the Pirate Christopher bot, and Pirate Eddie bot, hey, what do you think? Let's argue with each other and steelman this. The way that this works is that sales has a synthetic customer, marketing has a synthetic customer, and finance has one. And they say, this is what they've all said. And then they all kind of duke it out and see kind of what the answer is, which is the way business is supposed to work. It's not a tug of war. We're holding each other up. Sales and marketing, holding each other in balance. Sales and finance, all the same things. And so number one, you got to take the synthetic customer out of market research and into the function. And by the way, the CEO and the board needs a synthetic customer of their own so that they can stay on top of the business. So that's kind of the first part. The second part is what you and Brie alluded to, is that, Larry Ellison just talked about this, is that the reason why there's going to be mass commoditization of LLMs is because they're all being trained on public data, and it's all reversion to the mean.
Eddie, sometimes it's like you're in my mind. Keep going.
And the reality is, the only thing that will matter, the different is what matters, and different data sets, proprietary data sets, is what matters. And that the synthetic customer is only as good as if the super consumer that you train them on. Now, this is a real issue. Back in the day, when I wrote super consumers, when at my old firm, which was acquired by Nielsen, there's a certain company, big CPG company in Cincinnati, may have the letters P and G in their name, but I'm not going to disclose who they are. I got called to the principal's office for actually writing the book. It was kind of fascinating to me that in Christopher and Brie, we live in America, right? We have freedom of speech, I think. They were lambasting me for daring to write this book that said that, hey, there's some customers that matter more than others, because they had built their business predicated on the mass consumer. And so when you have this idea of a synthetic customer built on super consumers, there's going to be mass organ rejection. So just be prepared for that. There's going to be loads of people say, why are you doing that? You want the whole market. And what do we talk about at Category Pirates? When you niche down, The riches are in the niches. And so,
Niches. There's
absolutely.
another thing that you taught me that I want to make sure we get your feedback on. When you think about data analytics overall, so you think about customer survey data by way of example, because we're talking about synthetic customer. Well, what do? We put that on a bell curve, and all of us got taught, well, I didn't because I didn't go to school, but those of us who went to business school got taught, focus on the fat part of the bell curve, right? The bell part of the bell curve, because that's where all the action is. That's where all the customers are, et cetera, et cetera. We want to understand those customers. And is there value in understanding what's in the fat part? Absolutely. And what I got taught by Dr. Eduardo Yoon is that it's very interesting what's going on the edges of the bell curve. So why are the people not doing much with us, not doing much with us? And most importantly, it turns out the super consumer is the 8 to 10% of our customers that in some cases can drive as much as 90% of our gross margins. Yes, Eddie? So here's the dream that I think we have. You correct me. Is that people will use this new customer experience technology, synthetic customer capabilities, not just on the fat part of the bell curve, which is how they scale average, but what's going on with their supers? And what if we instrumented our business for our supers? What if we could synthetically figure out what supers will do with this new carbidingulator? Because they're the ones that drive the entire business. They're the ones that drive the WOM, the word of mouth. They're the trendsetters, et cetera, et cetera. What say you?
Well,
You?
I think you painted the perfect picture. And in the same way that we talked about, why was Jensen right about radiology that demand would go up? When you make it cheaper and faster through AI, you want more x-rays, right? And so what does synthetic consumers do? It makes the demand for this kind of data go up. And so why do people do it on the fat part of the bell curve? It's because it was expensive. It was time consuming. You didn't have, you couldn't run an infinite number of consumer studies. And so now with synthetic consumers, I say run them on all parts of the bell curve because the thing that matters the most, now sequence matters. You should always run it on the super consumer side of the bell curve first. But then the real value is not in the middle. It's next. It's run it on the supers. And then guess what? Run it on the non-consumers side after that. And when you see a bridge between a super and somebody, it's the green eggs and ham problem. I will not consume this category on a plane or on a train. I will not buy them, saying I am. When you get those two things to meet up, guess what happens is you get the middle. Now, the last couple things I'll say on this one, do it on the consumers, do it on super geos. So you want the top zip codes, do that with the highest per capita spending, and then do it on where it's non-existent and you meet in the middle. And the third test is the super of 1 is a super of 9. This is the one that people will miss. If you got synthetic consumers, they don't have to be relegated to just your category. If you can crack this code on the other categories that they buy, the cost of customer acquisition will go to zero. That sounds
Once
good
you
to most
know
people.
that people who like their whiskey neat drink their coffee black, you have a superpower. And one other thing, we'll get to this on another show, I'm sure, probably more than once. Everything I think you said about custom context LLMs, about custom data sets, proprietary data sets, this is the future. I've been working with AI startups for years now. The generic AIs are unbelievable for lots of things, but Larry Ellison is right. Look for purpose-built, context-aware, very deep, niche-oriented, functionality-oriented LLMs and AI applications going forward in the enterprise.
Like the Pirate Christopher bot and the Pirate Eddie bot. Anyways,
Exactly.
topic
By
3.
the way, I've been telling people the Pirate Christopher bot is essentially the same as the Pirate Eddie bot. It just swears at you.
It does some other things differently too, though. You got to give it some credit. It does other things different.
Well, it's not as handsome as the Eddie bot, but whatever. It's trying to figure it out.
What are you going to do? All right, gentlemen, you're on fire today. We'll move on to topic 3, swinging for the fences. The QQQ, the Nasdaq 100, is up around 600% over the last 10 years, which is roughly 21% a year with dividends reinvested. The S&P 500 did about 13 to 14%, which are both extraordinary. You didn't need to do anything exotic to get rich. You just needed to sit still. Now, look at where the younger generation is putting their money. 32% of Gen Z investors have already played prediction markets, and roughly the same share are in crypto.
They're putting about a quarter of their portfolios into non traditional assets. The punchline is about 69% of poly market accounts have lost money since 2022. Would have been funny if it was 67% for the younger generation. Over 100,000 are down at least $1,000, more than double the number that won that much. So the FOMO has changed. It used to be winners versus losers. Now it's Grand Slam winners versus people who only hit a triple. The QQQ handed you a triple every year for a decade, and a whole generation said, not good enough, I want the fences. Why? Because this is the most anxiety ridden cohort in a modern memory. And they come by it honestly, the triple whammy. Gen Z grew up in the shadow of 9/11, the 2008 hit when they were kids, and then COVID landed right as they were launching into adulthood. And millennials caught the same sequence a few years later, which is why they're richer than any generation before them and still can't stop worrying. Every institution that promised them a safety detonated at least once before they could legally drink. When that's your formative data set, put it in an index fund and wait 40 years doesn't sound safe. It sounds naive. If there's no pot of gold at the end of the rainbow anyway, then why not bet the farm? The speculation isn't stupidity, it's a rational response to watching certainty fail. So, Eddie, you've both made real money the quote unquote boring way now. When the boring path produces 10 to 20% a year, why does an entire generation still swing for the fences? And is this anxiety a bug we have to talk them out of, or is that exact instinct what creates the next wave of categories?
So this is a topic near and dear to all of our hearts. It's why we wrote Curator Capitalist and why financial capital. We spend an extensive amount of time talking about it. And so, I mean, what's interesting is that I have gone through all three of these phases of speculation, or I've lost stupid money betting on stupid things when I was a kid, and then I've moved to smart, safe money, right? When I got married, when we had to buy homes, when we had kids, and this and that. So and then, now that we're at a point where, we're in a position to speculate, we speculate with an information edge based on our superpower, which is really, really important because I did not have my superpower when I was starting out in my early 20s. Now, here's what's important is that, so I think that everyone has gone through these stages. So Gen Z is not alone. The thing that I worry about, though, are the life stages that we talked about. There are some forcing functions that happen when you get married and when you have kids. Your risk profile changes. It's the reason why minivans become bought by people with, babies and not by Pirate Christopher and the like, right?
I
And
love
so
your blue minivan, Eddie.
we all love the blue
It's
minivan.
so sexy. It's so
Yes,
blue.
yes. I know you have a soft spot in your heart for it. So here's the question is, will Gen Z get to that same level of come to Jesus realization if the life stages don't happen? And so the reason why we wrote Creator Capitalists is that you actually need three buckets of investment. You need a safety net. That's the rainy day stuff. And it needs to be in cash or something that you can access within 24 hours. You need it to be, at a minimum 3 to 6 months of living expenses. If not, a year to year and a half would be ideal. It should be boring, vanilla, and it should not grow past that amount. You don't want it to be there because inflation is going to eat that away. Then you have smart investments. These are the things that if Warren Buffett says when he would give advice, 90% in an index fund, 10% in cash, really hard to argue with someone like that. And with the Nasdaq, the QQQ index, if you want a little extra spice versus the S&P, you can go there and get outsized returns because guess what? When we talk about the Mag 7 going to the Mag 10, the Nasdaq is going to rise a little bit faster than the S&P. So if you want a little spice but still be smart, that's the way to do it. And then speculative. Now, here's what's interesting is that I do think you need to touch the hot pot so that you know not to do it going forward. So a little bit of this is fine. Be it, if you're doing Bitcoin, crypto, or if you're, what we saw in Korea is that, SK Hynix and Samsung are paying workers 400 grand bonuses, which is unheard of in that country, just to keep working extra shifts, keep it going, because the demand for DRAM, which is a critical component to AI hardware, they're sold out. They were oversupplied 4 or 5 years ago, so they didn't invest in capex. Now they're undersupplied. Now they're investing ahead of it, and it's a bonkers market. Micron is up. SK Hynix is up. Actually, what's interesting, Christopher? If you would put $1,000 into, I think Anthropic just raised 65 billion in their latest Series H. If you put $1,000 in their Series F and what you're worried about now, you would have made about the same as much money if you had put $1,000 into Micron, SK Hynix, whatever, just last year, right? So we're not saying not to speculate. We're saying to do all three at the same time and be clear about what money is going to where, and that when you speculate, do it a little bit. Don't blow yourself up so that you know the pot is hot and not to burn yourself, but do it with category design. Do it with your superpower. Make sure that you have not inside information. You're not a senator, so you can't do that just yet, but with expertise and superpower driven information about something you know that Wall Street does not. And if you have that, then that's a safer way to speculate. But just know that it's a 30-year time. And the way that Pirate Christopher does it, he speculates with his time and his expertise more than financial capital. There's a lot of merit to that, and he can explain why.
Yeah, so I love this conversation. I was just doing a little bit of poking around on the eyes, and there's good news and bad news here. Approximately 62% of American adults own stock, which sounds like a very good number. However, this is the big problem. The wealthiest 10% own 87% of all publicly traded equities. And while 87% of households that earn over $100,000 own stock, it drops to 28% for those earning less than 50. And so the first thing I'd say is everybody needs to be in the market. Look, the S&P 500 for the last 70 years, I believe we can double check it, but I believe the average rate of return is 11%. And most of the AIs and most of the financial planning experts will tell you for planning purposes, assume 7 net of fees, taxes, etc. Okay. So what does that mean? Let's just say stay with 10% because, grade 3 math was the hardest 12 years of my life. So if you have $1 million in the S&P 500, you're going to be generating roughly $100,000 a year while you sleep. And if you have $2 million in the S&P 500, you're going to generate $200,000 a year while you sleep. So the objective here, regardless of your age, is a very simple one. And why we don't teach this in school, I'll never know. You have what we around here like to call the pay for the party cost. What are all your expenses? Your mortgage, your car payments, your living expenses, your travel, if you want to do that, if you charitable donations, think your entire life. What does it cost on a monthly basis on average? Well, the minute your investments yield the same amount that it costs for you to live every month, every year, you're financially free. The minute they call it passive income, although the term I prefer is horizontal income. And I remember I had a financial expert on Follow Your Different Ones. And I said, why is it called horizontal? And he gave me this long explanation about how money you earn comes in vertically and this comes in horizontal. And it made no sense to me whatsoever. And so I've come up with my own definition of horizontal income. You ready? It's the income that rolls in while you're laying down. And I like to lay down. I don't know if you guys know this. I write laying down. I don't even like sitting up for this. I would like, if I could do this podcast laying down, I would. My favorite position is laying down. And so I'm a big fan of horizontal income, of money that just rolls in while you're laying down. And so that's the objective that we all need to get to if we're going to have anything close to a quote unquote retirement. Now, we never want to retire. That's the big retirement line. That's a conversation we can have because stopping work, I've tried. It doesn't work. It's really dumb. And if you're somebody who derives a lot of personal meaning from work, not working is a dumb thing. All that is to say, more people need to be invested. And here's a strategy that I've used very effectively. It's well known to be what's called a barbell strategy. So on one hand, you put most of your investments in fairly safe places like the Triple Q or the S&P 500, growing at roughly 10% a year. And then with your time, and maybe with some of your money, depending on how much money you have, but it should be as a percentage, a fairly small percent. And as your time, I'm willing to waste my time on things that might not pay off more than I am waste my money at this stage of my life. You can do speculative things. You can invest in startups. You can buy high flyers. I had a fascinating text thread conversation just recently with a buddy of mine who happens to own some SpaceX stock, pre-IPO, obviously, because they're not public yet. And he was asking my advice as to what I should do or what he should do. Should he sell his SpaceX stock when they IPO or not? And I said to him, look, I can't give you that financial advice. You have to decide. I said, I can only give you the lens that I have. So on one hand, I would ask myself, do I believe that wherever SpaceX stocks closes on its first day of trading, that it's going to be worth more in 10 years, 15 years, 20 years, 25 years? If you believe that and you don't need the money, you might want to let it ride. Because I know a lot of people who didn't let it ride on a lot of great companies and they regretted it. However, depending on your financial situation, if this is a meaningful investment for you, if you've been in this stock now as a private investor for several years and you want to diversify and sell your, in this case, SpaceX, and redistribute it to the S&P 500 and maybe a new self-driving car, then, that's fine too. However, the point is this: the barbell strategy is an interesting strategy for a lot of people. You put the vast majority of your hard-earned after-tax money in something that's relatively safe, but you know is going to grow at 7, 10, 12% a year. And then with some amount of your money and time, you invest yourself into earlier stage things, much more speculative things that potentially have a lot more upside, be it crypto, poly market, or SpaceX. But go in knowing the following: if I lose it all, how will I feel? And, the reality, at least for me and a lot of other folks I know, is the barbell strategy has worked well. You lock and load with the vast majority of your hard-earned dollars, and you do some speculating and you do some trading and you do some things to have some fun and maybe make some money because you're entrepreneurial. Both those things are okay. What's not okay is pretending like it's all Vegas and blowing it all. Because I'll tell you, you do not want to be 40, 50, 60 years old and have a shitty net worth because you blew it all on speculative stuff.
Well, can I say one last thing on this? Is that we wrote a mini book about removing the labels we wear as children, and I would say remember that money is not math; it's deeply emotional. And so, like I think partly if you are a Gen Zer and you have not really adequately processed what it meant for you at 9/11, what the great financial crisis meant for you and your family in 2008, and what COVID meant for you, then you're going to act out of emotion and not out of the safety net, smart and speculative buckets. And so I don't know if Bree, as somebody who is part of that cohort, I don't know if you have anything to add around that.
I think I've spent the past 5 years of my life, maybe longer, removing those labels and still do. And I think a lot of my peers have the same thing that they have to do within their identities and maybe don't quite recognize that that's something that has to happen in order to build your financial capital. And I think that's a very challenging thing that takes a lot of deep work and a lot of time and a lot of intentionality. And if you don't do it, the future continued to ride on these big swings of everything being unstable. So if you continue to believe that, that's how you're going to behave.
The other thing I'd say is it can be a positive thing. I remember the great crash, and I think it was 87, 88, somewhere around there. There was a huge crash. It was the very early stages of my career. And on one hand, I remember it being terrifying. And on the other hand, I remember thinking, I don't care what they throw at me. I'm doing this. And so, there is some real truth to the place where we all learn the most, whether you like it or not, is in times that are hard. Hard times create strong people. And so, is it fun when the stock market tanks? No. The financial crash of 2008, 2009 was not fun for anybody. And if you take the right mindset and say, listen, I don't care what the stock market does in the near term. I'm playing a long-term game here. I'm betting on me. And yes, I need tailwinds to help me. We all do. But no matter what, I'm going to figure out how to win. This is up, Dr. Seuss, you mentioned Dr. Seuss. If it's meant to be, it's up to me.
The places you'll go, pirates. Thanks for tuning in today. We'll see you next time. And that's the Pirate Street Journal, the non-obvious from the obvious. If this gave you something to chew on, do us a favor and give us 5 stars wherever you're listening. And if you want to keep the conversation going, head to categorypirates.news/subscribe and become a founding subscriber. You get the Pirate Eddie bot and the Pirate Christopher bot, so you can jam on your business and your career with us anytime.